All right, guys. So today we will be discussing all the ICT terms that you need to know, and some of them are basic, some of them are much more complex. And at least we will go through all the basic definitions and what you need to know, how to identify them, and how to use them in your actual trading. All right. So first of all, let's start with the FVG or the fair value gap. All right. So what is a fair value gap is when it is a combination of three candles. Okay, it is a combination of three candles, and whenever you see three candles with one candle like this, the other candle passing through with force, this is aggression, right? This is also known as displacement, and now we weren't able to close all the way back in to the wick of the previous body of this candle, right? So as you can see, the wick is here for this candle and the upper wick for this candle is here. So this gap in between is a fair value gap, right? When it is big, when it is made by three bearish candles while moving down, then it is known as SIBI, or sell side imbalance, buy side inefficiency, or BISI, when it is formed while moving up, right? As you can see here, this is also a bullish fair value gap. Now, this is known as a BISI. All right. The difference between a CB and a BISI is when is it formed? When the market was going up with bullish candles, or when the market was going down, or like CB in case of bearish candles. Now, there is a very important concept in FVG. As you can see, I have this middle line. This is exactly the point 0.5 of this fair value gap. This is known as consequent encroachment of a fair value gap. Technically, if we are moving up, you need to see the bodies that they are not closing below the consequent encroachment, and if we are moving down, you want to see the bodies not closing above the consequent encroachment in case of a SIBI, right? Bodies are allowed to do the damage, but I'm sorry, the wicks are allowed to do the damage, but bodies tell the main story. So that is where consequent encroachment becomes helpful to identify the actual order flow right now in the current market scenario, right? All right. So moving on to the next term, we have a breaker block, right? So how does a breaker block forms is when we tap in some sort of buy side liquidity, right? And we have sell side here, right? What we do is, for example, if we are moving, if this is a buy side liquidity level on top side and a sell side liquidity on the bottom end, for example, if we have moved up and then we have taken this buy side liquidity and we have dumped, right? So I am pretty sure that there will be an order block here that would have been used for going longs, but now since we have inversed this, since we have moved past this and now we have dumped through the order block, this order block will be used as a resistance. Now we can short when the price retraces back into this, and then we can try to hop on the longs for the sell side liquidity. Now this also leads us to what is an order block, right? So an order block is when the price moves from consolidation with force, right? When price moves from a consolidation with force, for example, this, right? This is an order block. Why is this an order block? Because you can clearly see that this order block, we push the price down, and we also have left this fair value gap, right? It is very important for us to leave a fair value gap, otherwise it won't be considered as an order block. It will be your simple supply zone only. Fair value gap marks the displacement, that force was there when the price was moving down. So this should have acted as a order block. Now what you can see is the price pushed up again, and now we took support from this area and now we moved up. So now this acted as a breaker block, right? All right. So that is what a breaker block and you can say fair value order block combination is. This price, if we wouldn't have changed structure here, would have acted as you can see also here, right? This was used to short here, again to short here. Eventually we surpassed this, we changed the structure, and then we moved up on the inside. While we are talking about changing structure, we can also discuss the MSS and CISD. Now we can use both the MSS and the CISD. For what is an MSS? MSS is a market structure shift, and CISD is change in the state of delivery. Okay. Market structure shift or change in the state of delivery. Market structure shift and change in the state of delivery both can be used for trying to identify a structural change. This When this high gets broken, this is known as an MSS. Mind you that you have already reached here some sort of higher time frame POI where you do expect the price to move up, right? So after that happens, this is where you expect the price to change direction, and this is where you expect the MSS. CISD on the other hand is when the body is close above consecutive range of down close candles. For example, let's use this example. Okay, so what happened was we have built up all of this trend line liquidity on the downside, right? We built up this liquidity. Then what happened? We took this buy side liquidity and then we reverse the structure, right? This is the candle which marks this is the exact candle which marks the CISD. Why? I will tell you exactly why. Because one candle, two candle. These two candles mark the consecutive range of up close candles, and when one of the bodies close below that, that should be considered as a change in the state of delivery. Okay. So now after this happens, we should be looking for shorts. There was a beautiful short from this fair value gap. I actually took this short as well, and I have uploaded that on my Instagram page as well. You should check that out. And this was a fair value gap. I waited for a retracement into this fair value gap to eventually take out the previous day low here. Okay. So okay. Next, moving on, we have to discuss volume imbalance. Okay. So what is a volume imbalance is? Volume imbalance is the gaps between the candles that you see. They are an important point of interest. When you can see it, they can be considered as a draw on liquidity, right? So volume imbalance are the gaps between two candles, right? You can see this is where the candle opened, this is where the candle closed, and this is where the candle opened. Yes, we did wick through, but we left this difference, right? Will be of course a new day opening gap. And but if we would have opened this here or maybe above this, then we wouldn't have formed this daily volume imbalance. So on a lower time frame, this is also an inefficiency. When the price approaches this area, this can be considered as a draw on liquidity so that the price can draw towards. Like, for example, when you consider this, what happened? We took out this sell side liquidity, right? And then we have also left this volume imbalance, right? So we took out this sell side liquidity and we were reversing around this candle, we can reasonably expect the candle price to hop into this draw on liquidity and eventually this draw on liquidity, right? Now, we also left this volume imbalance, right? So we stay in structure and then you can easily see what happened. This was within a fair value gap as well. This can also be used as a fair value gap. You can see how the daily volume imbalance is being perfectly aligned with the consequent encroachment of this daily fair value gap. So this is how to use this is how to use volume imbalances. This can also be, you can mark that on 15 minutes, 5 minutes and all. But I think that marking them on the daily time frame is much more reasonable and much more feasible for you to find your draw on liquidity when it comes to actually trading, right? Okay, so moving forward, we have market maker buy model and the market maker sell model. Now, how does a market maker buy model and a sell model operates? First of all, we both know, you and me, right? The one who is watching and me, of course, we both know that when a market is moving up, it moves like this. Of course, not as smooth as this, and in change the structure that it moves like this. Now, as per ICD, every move is fractal, right? Every move is fractal. So the market will be moving like this, and this. Okay, so you get what I'm saying, right? This is the fractality of time. ICT says that every move, every wave that you see, even the short ones here, even the longer ones here, all are are a form of market maker buy model or a sell model, right? So whenever the market moves up, it first has a sell side curve like this, and then it does a reversal like this, and then it goes up, right? The move on the downside will be exhaustive. It will leave some liquidity uh, in between, maybe some equal highs, maybe some relatively equal highs, and then we will keep on moving down until and unless we reach our higher time frame POI, from where we reasonably expect a reversal. This is where we form um, CISD or MSS, and technically we usually also form some sort of SMT here as well, right? Maybe between this high or between this low, and then we start moving up and up and up into our next area as per the higher time frame. Now this brings us to what a SMT is, right? So what an SMT is, let's say that NQ or ES, right? They both are correlated assets. Now, what is a correlated asset? Correlated asset is, let's say, they are supposed to move in tandem with each other, right? So if ES is moving up, then NQ should also move up. If gold is moving up, then XAG or silver should also move up. If Euro USD is moving up, then GBP USD should also move up. If Euro USD is moving up, then USD CAD should move down, right? So this is an inverse correlation, right? A direct correlation is when both should move up together or both should move down together, and the inverse is true for a contrary relationship, right? So you know what is a correlated asset now. Now, talking about what is how to actually figure out an SMT, right? So figuring out an SMT is actually easy. Let's say that we have formed a higher high and then we have inverse, right? If we have formed this higher high, we have took out the buy side liquidity, and then we did the CISD or MSS, whatever you want to call it, and then we actually reversed and we broke the structure towards the downside. What you can notice is this is by default. I'm always saying this: SMT should not be the reason for you to take a trade. SMT is a confluence, okay? It is not a reason for taking a trade. The structure should always be the reason for taking a trade. It can just be a confluence that can make your trade much higher probability, right? All right, so we have formed a higher this is a high, another higher high, and then we push lower and broke the structure. Let's say this was on NQ, right? Now when it comes to ES, we have formed this, but we form a lower high and then we broke structure, right? How to actually use that, right? If we broke the structure, now we are looking for shorts. So now I will be looking for shorts from this breaker block to eventually take a short here. And now I can in ES I can use this mitigation block to use the short here. This brings us to the actual concept of mitigation block. Now mitigation block is nothing when we have formed a higher high and then we reverse. This is known as a breaker block, right? The order block at this level. This is known as a breaker block. But what if we form a failure swing, right? If we form a failure swing, let's say like this, and then we reverse, right? Then we reverse, then this order block at here will be known as a mitigation block, right? This is what a mitigation block is. If you can pair this up with, I would advise you to always pair this up with an SMT, because I will tell you why it does not make sense. Because now I will be moving on to the next T term, because now you have also formed these, right? This high is lower than this high, right? The problem is when we form like highs like this, these are known as relatively equal highs or relatively equal lows, right? This is a relatively equal high and this is now a relatively equal low. The problem is you had generated liquidity, so I would always advise you to take a short on mitigation block only and only if it is combined with an SMT, right? For example, if this is ES on NQ, the price should have done this, all right? That is only and only when it should make sense. So we have formed relatively equal highs and relatively equal lows. Relatively equal highs and relatively equal lows is like a liquidity pool, just like any other liquidity pool. Let us say maybe a session liquidity pool, right? Maybe a London highs, Asia high and low, Asia high and low, or and NYPM, NYAM, lunch high and low. Okay, PDH, PDL, PWL, PWH, or PML, PMH, PMH, or equal highs, equal lows. That's pretty obvious. And all of these are liquidity pools, right? These are external liquidity pools, or they can be internal liquidity pools depending on what is the dealing range. Now, what is the dealing range? Dealing range is actually pretty easy to identify, and I will tell you exactly how, right? Just zoom out the chart and just tell me what is the range that you see. I see this, right? This is the current range on NQ. This is NASDAQ, and this is the current range on NQ, right? Can the dealing range change? Absolutely, right? So any liquidity below this, below these, below this, or maybe any fair value gap that you see inside here, like this, is known as internal range liquidity. What is external range liquidity? These highs. This is ERL on the buy side, and this is ERL on the sell side. Right. On the buy side. Okay. What the market tends to do is market moves from ERL, IRL, ERL, IRL, ERL, IRL, IRL, ERL, IRL, ERL. Okay. Market will keep on moving from ERL, IRL, ERL, IRL until unless the market structure is intact, right? When we break this, this is an ERL. When we retrace back, maybe into a breaker block, maybe into an order block, maybe into a fair value gap, this is an IRL. When we break this again, then we have formed ERL, IRL, ERL. Now this, if I consider the dealing range to be this only, then this high, when this high gets broken, this will be ERL, right? And this will be ERL as well. However, now since we have changed the structure and we have done the MSS or the CISD, now we have turned bullish, right? So now what do you expect? You expect an IRL for the price to head higher for the ERL, right? So IRL and ERL. ERL, again, price heading back here. Maybe this can be a breaker block and then a mitigation block, or and then ERL, IRL again here, and then we again another leg of ERL, right? So this is how price goes from ERL to IRL to ERL to IRL to IRL to ERL to ERL to ERL to ERL again when it changes structure. Do you need to know all of this? Do you need to know this? This is, I don't think so. You don't need to know this because see, when whatever price time you trade, right? Market does only and only two things. Price only does two things. It either run stops, or it fills in inefficiencies. What is an inefficiencies? Fair value gaps. Fair value gaps, order blocks, breaker block. People might tell you that only an FEG is an inefficiency. I don't consider that because what I consider an inefficiency is rebalancing of a price range, right? For example, if this is a dealing range, for example, let's consider the fact that we have rallied all through the previous day and now we have been consolidating, let's say, throughout London, right? And now it is the NYA, right? What do you expect the price to do? Do you expect the price to move up again? No, you expect the price to go down into some sort of discount, Maybe it can be an FEG, maybe it can be taking out of some previous day low, or maybe some NYPM low of the previous day low, and then changing structure to move up again, right? We would have left relatively equal highs on top, then we would have moved back into discount, and then we would have changed structures, maybe by an MSS or a CISD to move again on the upside. So what was this? This leg was the IRL, this leg was the ERL, right? This is how market runs from premium to discount to premium to discount, and again until unless we change structures when we reach the higher time frame POI. Now, again, what I would like to say is consider the fact that when you are at 9:30, right? What do you want to do? You want to wait, right? You need to have a bias depending on the hourly structure, 15-minute structure, daily structure, whatever your draw on liquidity is. You need to first wait, right? And then the price should take out an opposing side of liquidity, an opposing side of inefficiency. It should balance the range in general, right? Because when it will balance the range, it will take out some sell side liquidity, obviously, right? It will take out some sell side liquidity, or maybe it will tap into an FEG, and then to change structure, it would have been an A plus if we can go below the 8:30 open or the midnight open. Now this brings another concept here, right? What is a 8:30 or a TDO, right? So 8:30 and TDO is 8:30 open is the opening price of the 8:30 candle. I want to show you what happened yesterday. I'm going to remove all the drawings right now, and let us focus on what happened yesterday, right? This is what the trade I took, and you can see this is the 8:30 candle, this is the 8:30 open, right? And what was the, I would say, midnight open? This will be considered as the midnight open, right? So what happened was, these were the London highs, right? This was the London high, and I wanted to see price go down because just look at the structure, right? Just look at the structure. Isn't it just too obvious for the price to go down, right? So what happened? We came in, we took out the London high, we went into the previous order block, and then we changed structure, then we went into IFEG. Now notice how all of this, taking out the buy side liquidity, hopping into the order block, in general rebalancing price range is happening above the true day open and the 8:30 open, right? So true day open and 8:30 open is above, anything above 8:30 or the TDO is premium for shorts, and below 8:30 and TDO is discount for longs. So what do you want to see? If your bias is bullish, you want to see price taking out some sort of sell side liquidity, eventually running the price through this changing structure, and preferably this all should happen below the 8:30 open and the TDO, right? This would be an A plus setup. All right. Similarly, it should be inverse for shorts, price heading higher to take some sort of buy side liquidity or fill up an inefficiency up above the 8:30 open and the TDO to eventually inverse the structure, change the structure, do a MSS, and then eventually running lower, maybe some sort of IFEG, and then running on the downside. Now, what is an IFEG? This is the last concept for today. What is an IFEG, right? I will show you the example of yesterday's trade for this. Now, if the price is supposed to support a bullish fair value gap when it is moving up, and it is supposed to move down from a bearish fair value gap, right? Then what do you think happens when we close below a bullish fair value gap? Is that a negative sign? Yes, it is. All right. So, price was supposed to support if it wanted to move up from this fair value gap, right? This is what we learned. But what happens is, when the price starts and closes below this fair value gap, this is a negative sign. So this is where I entered yesterday, right? I put my stop losses above this candle high, and I pushed all the way into the previous day low, and I went out. right? This was a beautiful, beautiful trade. This was 193 points on Nasdaq, and it was too beautiful to be true. All right. So this is what happened yesterday, right? This is how you use FEGs. So what comes down to is bias, right? You have a bullish bias, you have a bearish bias, right? So what do you want to, what do you want the price to do? You want the price to take some sort of liquidity, some sort of fill up of inefficiency, and you want to see inversion, right? You want to see the price doing either IFEG or CISD, whatever your entry model is. I don't use one, I use multiple entry models. I can even hop into 15 seconds, 30 seconds to find an entry if I am confirmed with what the bias is doing. So all right, so this is what you want to do. You want to see an opposing run, then you want to see a CISD or MSS or IFVG, and for your entry, and you want to target the next draw on liquidity in your direction. In your direction, if the price goes above the TDO and the 830, then it becomes an A plus set. Because now, if the price is above both the TDO and the 830 open, then this is a deep premium for shorts. And similarly, a deep discount when the price is below both the TDO and the 830 open. Right? This is how to combine the 830 and the TDO um, for your premium or discount for the day, right? So that's it for today. I hope you learned something out of it, or maybe brushed your concepts as far as ICT concepts goes. So that's it for today, and let me know if you want any other video, any other topic. I'm ready to do anything that you like guys want. And that's it for today, and I will see you in the next video. Till then, peace out.